So far, we have focused primarily on single-day risk measures, value at risk, tail losses, and stress scenarios. However, many of the most damaging risk events are not single-day shocks. Instead, losses often accumulate over time, which is why drawdowns are such an important risk metric. A drawdown measures the decline from a portfolio's previous peak to a subsequent trough. Unlike VaR, which looks at isolated daily outcomes, drawdowns capture persistent losses over time. They answer a different question. How much can the portfolio lose before it recovers to a new high? The plot on the screen below shows the drawdown of the portfolio over time. Whenever the portfolio reaches a new peak, the drawdown resets to zero. As prices decline, the drawdown becomes more negative, reflecting cumulative losses relative to the last high. What's immediately visible is that drawdowns can last for extended periods. Even in the absence of extreme single-day losses, the portfolio can remain significantly below its previous peak for months or even years. This persistence is what makes drawdowns particularly challenging from both a risk management and also an investor perspective. A key summary statistic is the maximum drawdown, which represents, as said, the worst peak to trough loss observed in the sample. Looking at the table, the maximum drawdown is approximately minus 33.7%. In monetary terms, this corresponds to a loss of roughly 337,000 on the assumed portfolio size. This number is significantly larger than any single day VaR or stress loss we examined earlier, which highlights how cumulative effects can dominate overall risk. Drawdowns expose a fundamental limitation of threshold-based risk measures like VaR. A portfolio can stay within its daily VaR limits and still experience a severe and prolonged drawdown. From a practical standpoint, large drawdowns can trigger, for instance, margin calls, forced deleveraging, or investor redemptions, even if no VaR limits are breached. This is why drawdowns are widely monitored by asset managers, allocators, and also risk committees. Drawdowns also matter because they directly affect investor behavior. Long recovery periods can lead to loss of confidence, strategy abandonment, or poor timing decisions. So from a risk management perspective, understanding drawdown behavior is essential for setting realistic expectations about capital volatility and recovery times. In practice, drawdowns are not a replacement for VaR tail risk or stress testing. Instead, they complement these measures by capturing a different dimension of downside risk. Together, these metrics provide a more complete and realistic picture of market exposure. With drawdowns analyzed, we now have all the core ingredients needed for market risk assessment. In the next section, we'll bring everything together by assembling a concise market risk report that summarizes these results in a decision-ready format.